Good morning, everyone. Marty Missouri here, October 19th, 2021, Tuesday. This is going to be just a very quick technical update for you. I'm going to look at the S&P 500 and the dollar. The chart in front of you is the S&P 500. I'm going to start with the shortest time frame that we looked at time before last, and then work our way up all the way to the monthly chart. And then we'll jump over to the dollar and I'll show you what I'm thinking there. Recall, again, time before last that we were looking at a very bullish short-term pattern. This was unambiguously bullish. You had a nice falling wedge, and you had your very distinct bullish divergences in these momentum indicators. And sure enough, we got a nice pop out of that, a nice little gap right here. Kind of consolidated that. We kind of moved down here, and again, each candle is an hour down. Call this a channel right here, but nothing really occurred bearish. Certainly not in the MACD. Right, we were still moving in the right direction in terms of the higher lows. You could argue that from this point on the RSI, there was some question there that might have been, that we might consider that a bearish divergence, but it certainly didn't play out that way. Market came bounding out of that. Now you could argue that we keep going in this pattern, that becomes bearish because that's a rising wedge, right? But we don't really have anything negative here. Certainly this confirms this move bullishly, right, in terms of the uptrend line. But again, folks, this is just a short-term hourly chart, which certainly doesn't dictate what we do with our portfolio. But I keep saying, I know a lot of you are looking at this stuff every day and apparently find these technical analyses interesting. Now, when we get to the longer term charts, we'll get more of a technical picture as to probabilities, whether or not this bull market continues. So the 2-hour chart, actually you can call this down here, it's more of a falling wedge than it was on the hourly chart. And that's bullish, particularly when you have, continued bullish divergences. But this shape in terms of the movement here does ultimately look wedgy, and that by itself is bearish. You can see the MACD histogram here is suggesting that may be in the works. And of course, market's going to roll back over. The question is that longer term trend going to stay in force? And we'll take a look at that here as well. Okay, so now the more meaningful for our purposes, certainly, daily 1-year chart for the S&P 500. So recall when we did this a couple weeks ago, we were breaking down noticeably below the 50-day moving average, tested it, failed, tested it, we're failing again. It looked like something we haven't seen over the last year, and maybe something meaningful to the downside. And I continued to say that, the bulls need to see this thing break back above with some momentum, the 50-day moving average, and then recapture this trend line. Well, we can check the 50-day moving average box, right? But we can't check the trend line box just yet. But again, a nice bullish move here. Remember, we pointed this out time before last that we were getting a nice bullish divergence on the RSI. We weren't having that on the MACD, but we did get the beginning of a nice little buy signal, and that's really gained momentum. So, we've had 4 up days in a row. Today is another strong day. Of course, we won't go up every single day, but from a short-term perspective, this looks pretty bullish. And you can see the momentum building and so on. You still, longer term, however, you still have these real serious bearish divergences. I mean, we aren't even close to correcting those. So on balance, what this suggests is, whether it's in the next week, the next month, this quarter, next quarter, that sooner or later these divergences are going to have to remedy themselves, or we're going to see something meaningful to the downside. My guess is, that's how this will play out. It doesn't mean the bull market's over, but boy, are we overdue for something more meaningful than that 5% drop in September. But, as we know, there's kind of this implied put underneath the market on behalf of the Fed. But at the same time, and I'll definitely spend more time on this on the written blog, we do have some big pressure on them to begin, tightening at the margin, monetary policy. Clearly, they're going to begin tapering their asset purchases. The market knows that. Question is, are they going to start raising interest rates? As I said in yesterday morning's blog, I think they'll give it a go at some point. I think there's very little they can do with interest rates to the upside. They really got themselves in quite the pickle because we have serious inflation pressures, no doubt about it. And even the Fed members themselves are beginning to talk about something other than transitory. And but you have some of the economic data rolling over. It's not all bad. You notice that our index here on our weekend update, our macro index was showing some improvement. But the U.S. The economic surprise index is in the negative. That means that the economy isn't firing on all of the cylinders, so to speak, that the economists had anticipated. Growth is slowing, no doubt about it. Policy is tightening. Questions over fiscal policy going forward. I think we should anticipate that politics, as usual, will rule, and we will get an infrastructure bill passed, and we'll get a spending bill passed, and the markets will probably like that on those announcements. But longer term, we have inflationary pressures, and that could exacerbate that, and we have a market that really, frankly, has no stomach for consequentially higher interest rates. That's quite the conundrum that we're going to have to navigate through going forward. And just super quickly, the weekly chart still in a sell signal, although beginning to show some improvement there in the MACD, still below this trend line, still in an upward wedge, still in our bearish divergences. So yeah, the weekly chart looks suspect for sure. The 10-year monthly chart, however, looks better. From a long-term trend perspective, yes, we do see, a bit of rolling over here, in terms of the momentum on a monthly basis. We have broken down below this trend line here, this rising wedge. We do have a bearish divergence on the RSI, but we don't have one on the MACD. So yeah, more constructive monthly chart versus the weekly and the daily that I just showed you. Okay, really quickly, we'll just look at the daily chart on the dollar. Our overall long-term thesis is a weaker dollar. I don't think we're in the majority. I keep reading lots of research and opinions that people think we're going to see a stronger dollar. Part of it is just a higher interest rate regime, here in the U.S. Treasury market, and the fear that the Fed's going to start bumping up the Fed funds rate. That's certainly reflected, as I showed you yesterday, in the 2-year Treasury yield and so on. But technically speaking, I think the dollar looks very bearish near term, right? We have clear rising wedge here, or we had till we broke through it. Bearish divergences on the momentum indicators, and we just broke down. Dollar's down a bunch today, despite the fact that U.S. yields have spiked much higher. The 50-day moving average kind of has a flattening look in there. Now, I've said time and again, on a near-term basis, I was very bullish on the dollar right here, despite our longer-term bearish, view. And sure enough, we bounced out of that. We had what was needed, in terms of technically speaking, for the dollar to get a bounce. Right in here, we've touched against what is at retracement level. So we peaked here. We had this big decline back in here, right up pretty much December. January of this year was the bottom, right? This got very bullish right in here, and sure enough, we bounced out of that, turned bearish, got our negative divergences a little bit here, and the market rolled over. So typically markets retrace, and the most watched areas are the 38.2, the 50, and the 61.8 Fibonacci retracement levels. We track these on all markets, all ETFs, and so forth. And sure enough, you had your upward wedge, as resistance right here ultimately, and you had that fib there of 38.2, and that's exactly what stopped this rally in its tracks so far. It could, burst above here. Also keep in mind, folks, what was going on during this big rally in the dollar? Stocks were correcting to the tune of about 5%. So what have I said for the last year or two plus? Is that this situation, these bubbles that, let's say, the Federal Reserve keeps, afloat, cannot withstand longer term a trending higher dollar. And therefore, we shouldn't anticipate one. I get it. Globally speaking, you could argue that the dollar, should be stronger on a relative basis. And some macro strategists who I respect think that is what we should anticipate. Others whom I respect as well do not think so. They're in our camp. And we are levering our portfolio toward, a weaker dollar narrative over the next few years. So we feel very good about that positioning right now. I'll say it again for the umpteenth time. Feel good about the outlook for the next 5 years based how we see the world today, always subject to change. Next 5 weeks, next 5 months, of course, who knows? The dollar is going to have a lot to do with how things shake out across all of the asset classes, frankly. I'll stop there. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.